Hello friends, welcome to Finavision, your one-stop solution for CFA classes. My name is Shushmit Aditya Mukherjee and this video is part of the full chapter videos taken as part of the CFA Level 1 curriculum. If you want to access more such videos, the playlist is given in the description, so please check that out. Keep watching and let's get started with this class. So friends, hello and welcome. Today we are starting a new chapter which is part of Corporate Issuers in CFA Level 1. The chapter's name is Capital Structure. Let's say it is the early 2000s, around 2002, and a person named Elon Musk is thinking of building a spacecraft company. He names the company SpaceX. His aim is to make space travel cheap and spacecrafts reusable, right? So he needs a lot of capital, right? Let's say he needs a total of 100 million. He needs a total of $100 million initially. Now, that is a lot of capital, right? How does Elon Musk plan on raising this capital? Let's say he decides to check out 3 or 4 options. One is he thinks about selling equity. So let's say Elon Musk right now holds 100% of this newly formed SpaceX and he decides that he will sell around 10 to 15% of it in equity form, right? And he will value this 10 to 15%, let's say at 50 million. Elon Musk plans to collect 50 million. Now 100 minus 50 is 50 million. So how does Elon Musk plan on collecting the remaining 50 million of capital? Let's say Elon Musk issues debt. Elon Musk issues debt which covers around 30 million, right? So 50 plus 30 is 80 million, right? Now, the third option, equity is done, debt is done. More equity cannot be raised as per the valuations, let's say, and more debt also cannot be raised. Elon Musk has got this debt only because of his previous reputation, because of PayPal and all that. But usually what happens is startups do not get so much of debt funding, right? But Elon Musk has got some debt funding because of his initial reputation. Now what Elon Musk does is he decides to issue preferential shares. Preferential shares or preferential equity. So through this preferential equity issuance, Elon Musk again gives away 5% of his equity stake and he collects 20 million. Right? What is the difference between preferential equity and normal equity? Basically, preferential equity gets preference before equity when some insolvency issue happens. So when some insolvency issue happens, first claim on the assets will be for the debtors. The ones who own the debt, they will have first priority of access. After that, the preferred shareholders will have the next priority. Preferred shares or preferred equity holders, right? Only after these two are satisfied, then comes the turn of normal equity holders. Obviously, we know SpaceX does not need any of this. It is well past of it and is a very successful company. Why are we saying all this? The reason is capital structure basically means how you are orchestrating or designing your entire capital resources for best efficiency measures. So capital structure in simple terms basically means how much debt you have, how much equity you have, do you have any preferred shares or preferred equity, do you have any warrants, any convertibles, etc., etc. This is basically how the capital structure is defined. We are trying to look at what are the sources through which capital is being withdrawn or picked up from the market. Now, Related to this, there are a lot of things that we have to understand, friends. First, what we have to understand is, what is the goal when you are trying to structure your capital, right? The goal is to make it optimal. Now, optimal, as it is, sounds very vague, right? Optimal, what does it mean? It means different things for different businesses. For example, if it's a startup, the priority is ease of access. Ease of access. A startup hardly gets loans. As I said before, for a startup, it is very difficult to get loans. Firstly, because it is not having very good cash flows. Secondly, it does not have very good collaterals. So, debt becomes very difficult. So, what it can do? It can collect capital or collect investments through equity. This is usually through private equity. So I'm writing private equity here, and this P here, this is preferred shares, right? Do not confuse it. Let me write preferred shares here. Preferred shares or equity, right? For a startup, ease of access to capital. This is one of the priorities. Obviously, then the cost of capital and the opportunity cost and the demands of the investors, all these things also matter. We'll come to them later. Next comes a growth company. So a difference between a startup and a growth company is, a growth company is also already doing very well for the last, say, 3 to 5 years or 7 years for that matter, right? It has very high sales, very high profits. Cash flow is still at the early stages, maybe it is also negative. That can also be the case. It is negative and the negativity is becoming less and less, and it is moving towards being positive, or it can also have free cash flows at the onset itself sometimes. So, but sales and net profits, they are growing very well, right? They are going very well. For them, equity still remains a very good option. Debt, they can access debt, but that can be in very high rates or it can be limited. Very low amounts of debt should be used, right? Because you do not want to create a drag on the finances, right? Now, if it's a matured company, and specifically if it's a matured company in a very defensive sector like consumer non-durables, like electricity, etc., like FMCG and all that, right? It is a defensive matured company. So what do we mean by defensive? The cyclicality is less. In that case, debt is quite accessible. Equity is also quite accessible and valuable. But the thing is, the valuations depend on the growth rates also and the future prospects also. If it's a industry where saturation has already happened and the growth rate is not that much there, then valuations will be lower. If it's a growing industry, the industry itself is growing and this company is also growing along with it, then the valuations will be very, very different. It will be much more higher, right? And depending on its long track record, its profitability statements, its cash flow statements, its debt repayment reputations, everything taken into account, its future prospects taken into account, the debt cost will also be ascertained. And generally it is going to be lower than the other two options that we have taken, like growth and startup, right? So for a matured company, debt, equity, both are equally accessible. And they do not need to depend that much on private equity or high rates of debt acquisition and all that, right? They have a much more advantage regarding this. Now, one thing that we are not considering here is, what is the cost that one has to pay to pick up capital? When debt is taken, the cost is very obvious, right? Let's say you are taking a 5-year debt. You are taking at, let's say, 8%. So we know what is the cost of your debt. But it is very, very difficult and tricky sometimes to actually calculate the cost of equity. We might see that directly it does not have any cost, but actually it does, right? Somebody is not opting to buy debt or not opting to buy another company's equity for your company's equity. So there is an opportunity cost. To measure this opportunity cost or cost of equity, there are various ways. We will discuss a few in this chapter also, right? So pertaining to this, what is the cost to be paid for this capital? The direct term that is used here is cost of capital. Cost of capital. Cost of capital is basically the combination of all these capital resources and their weighted average cost. Weighted average cost. We call it WACC actually, weighted average cost of capital. How do we calculate that? We'll come to that in a very, very short while. Just stay with me. We are just introducing what the topics will be and how we are getting into the flow. A few more terms. Cyclicality. What do you mean by cyclicality of a business? We have recently taken an example that the matured company is a defensive sector. Defensive sector basically means with the ups and downs of the market, the matured company does not become so much volatile. It is a little less volatile or a lot less volatile, right? The dotted line, you can say it's a matured company. This one is the general market on average, right? Now, what if it's a cyclical company? It will be much more volatile. It will be something like this, right? It can be pro-cyclical, which means its ups and downs will match with the market. It can be counter-cyclical also, or it may not match with the existing market cycles exactly also, right? What I have mentioned here, it looks that I am mentioning counter-cyclical, but it is not necessarily so, right? It can be pro-cyclical also. Like when the market goes up, it also goes up. Only thing, it goes up more. When the market goes down, it goes down more. This is also the way it can happen, right? But it need not be so. It can be counter-cyclical also, which means it will be something like this. When the market goes up, it goes down. When the market goes down, it goes up. It can be like this also, reverse, right? Or it can be completely asynchronous. It can be something different. It can be something like this, and then this, and then again like this. It can also happen like this, right? So this is what we mean by cyclicality. Example of cyclical businesses. One is exploration industries, oil exploration industry. It is very cyclical because there are phases when exploration is required in humongous amounts, and there are phases when the industry, the requirements saturate for exploration, right? How that happens, that is a different topic. How fracking happens and all that is a different topic. We can discuss it somewhere else. We have an internship program where we can discuss all these things. You can go and check it out. The link I am providing in the comments and description. If you want, you can check it out. But exploration is a cyclical company. Then there is shipping. Shipping business again is a cyclical company. Then there are things like seeds. Companies which are into seed growing or seed manufacturing. This is farming related, right? This is also very cyclical, and specifically it is seasonal. Same goes for something like sugar industry, the sugar producers or the corn producers. These are cyclical businesses, means with respect to seasons or with respect to market cycles, they go up and down, right? So this is what cyclicality means. Now for a cyclical company, debt is a fixed cost, right? Debt is like you have to pay a fixed amount of interest every month or every quarter or every year, right? So debt becomes less accessible. It is less accessible for a cyclical company. It can be a matured company also. But for a company of equal size, which is in a defensive sector, that will have much more access to debt and much higher ratings than a cyclical company of equivalent size, right? A few more categories we can also understand. For example, let's say a business is capital light business. Capital light business. Between the years 2000 and 2020, The prime example of capital light businesses could be the IT industries and the software product industries like Microsoft, Apple, Google. These are capital light industries if you consider specifically the time zone between 2000 and 2020. That has changed. I'll tell you why. Capital light means you are requiring very less capital to generate revenues. For example, Google generates $100 billion of net profit, and it has an asset base of $450 billion. Right? Now, if you compare this with something like a General Motors generates a net profit of around $7 billion, and it has an asset base. It has an asset base of around $270 billion approximately. I'm not exact on the numbers, but this is the kind of difference they have. So $100 billion they generate with $450 billion of assets, while General Motors only has $7 billion of profit, while its asset base is $270 billion. So obviously you would call Google a capital light company. Its asset base or capital base is much lower compared to something like General Motors, right? And it is not about the total asset base. It is about the efficiency of the asset base, which means how much revenue, how much profit is the asset base generating, right? 270 is generating 7, that is more efficient, or 450 is generating 100, that is more efficient. Obviously, the second one is more efficient. Google, in that way, is a more capital light business. Now, what is the advantage with these businesses? These businesses have very low requirement to raise capital. Right? This is the main advantage of this company. They will have great ratings. They will have positive free cash flows. They will be excellent in every way. And at the same time, they will not require to raise so much of capital. On the other end of the spectrum, there are capital intensive businesses. I already took an example of General Motors. General Motors is an example of a capital intensive business. So it is part of the automotive industry. Automotive manufacturers are generally very capital intensive. One more example can be utilities. For example, telecom companies. A prime example of a telecom company would be, friends, AT&T. Now, AT&T generates a net profit of around 10 billion, and it has an asset base of around 390 billion. So again, you can see the similarity with GM, right? GM had 270 asset base and net profit of 7 billion. Here also the numbers are of the same proportions almost, right? Look the same. The numbers look the same, right? So this is a capital intensive business. Now, what is the problem with capital intensive business? They need to keep raising lots of capital incessantly. The initial cost of setting up the infrastructure is very high. Then you have to depreciate that, right? So initial capital investment. Then there is regular depreciation, and depreciation amounts are huge. Then there is actual wear and tear of assets which you have to refurbish. This requires capex. So all in all, you have a hit in the net income or the net profit. That is the main crux of the story. So because there is profitability issues, there will also be cash flow issues. So because of such cash requirements, there will be cash flow issues also. And both net profit and cash flows take a hit. As a result, they are always in search of capital. And second thing is they have to raise a lot of capital through debt. They have to raise a lot of capital through debt because return on those assets are pretty slow to come, right? Let's say if you're building a transmission and distribution infrastructure or a telecom infrastructure, you are spending in billions, right? You are spending in billions. I'll take an example. The geo infrastructure of India. The geo infrastructure of India costed 2.6 trillion Indian rupees. 2.6 trillion Indian rupees. Right? This is the approximate cost I am telling. Which means, in dollar terms, I'll tell you, this will be somewhere around $30 billion. $30 billion, right? It will be somewhere around $30 billion. Anywhere between $27 to $30 billion, depending on the exchange rate. Now, this is a lot of infrastructure spending, right? And what they did is, they converted the assets into an infrastructure investment trust, which is called the InvIT, right? You have heard about InvIT. So they converted their assets into infrastructure investment trust, and which will guarantee a return of somewhere around 7-8%, I do not remember exactly. And they paid off this entire debt that they had to take up for building this infrastructure, right? It was in trillions of rupees. The debt was itself in trillions of rupees, and they paid it off in this way. So this is the telecom company, by the way. If you don't know, this is a revolutionary telecom company of India, Jio. It changed the landscape entirely. Currently, whatever the data costs are there in India, that is basically around 30 to 35 times less than the average global cost. The main credit, the main kudos goes to Jio, and it is part of the Reliance Group, which is one of the biggest groups, industrial groups of India, right? So, this is how it happened. And all I want to say is, if you are making telecom companies, if you are making electricity companies, if you are making shipping companies also. Shipping companies, I have already taken an example that they are cyclical. Yes, they are cyclical, that's true. Because they have direct relation, their freights have direct relation to markets. Directly is proportional to the market movements and also to the fuel prices and fuel demand and supply, right? So both of them are cyclical, and shipping is a little more cyclical than the markets and as much cyclical as the fuel prices, you can say. So shipping itself is cyclical also. But here we can also take an example of shipping as a capital intensive business, because to make a ship, to get it ready and to maintain it, to refurbish it, it takes a lot of capital. It is a capital intensive business. If you go into the merchant aspect of shipping, it is very cyclical. If you go into the defense aspect of shipping, it is even more cyclical, right? Because for example, an aircraft carrier, which is a ship on which the fighting jets can land and take off, that kind of an asset requires around $10 to $15 billion to build. A modern aircraft carrier takes around $10 to $15 billion to build, and it takes around 5 years. So, on one hand, the timeline required is very chunky. It is not uniform because of the building time required. Then the cost is also very high. You can understand that. So defense sector, merchant sector of shipping, both are cyclical and capital intensive, both, right? Another example can be mining industry. This is a very asset heavy industry. If you look at any of the mining industries, like coal industry, like iron, like lithium, they are all very, very asset intensive businesses, which means they are very, very capital intensive businesses. They require a lot of time to commission, excavation, and then refining. All these things require a lot of capital, a lot of time and all that. So this is also another example of capital intensive industries. Now what we are trying to get at is, these businesses need to keep on raising capitals, and their ratings are always at the risk of the vagaries of the market. One advantage of this business is, because they are very asset heavy and capital intensive, they have lots of collateral capacity, right? They can provide lots of collaterals, for which they can raise lots of debt. All these capital intensive companies or businesses, they can raise a lot of debt. Conversely, many of them may not raise debt. Modigliani-Miller proposition. What this is all about. So friends, we know something about valuation of a company, right? We already know that valuation or a intrinsic value of a company is the present value of all its future cash flows, right? All its future cash flows. Valuation of a company is the present value of all its future cash flows. Cash flows in the sense it's free cash flows. Free cash flows, right? Now, measuring free cash flow is a separate topic. Right now, we are more concerned with finding out the present value of the cash flows. So how do we find this present value? How do we find this present value, right? This is the question. The answer is, let's say a company is going to earn cash flows for next n number of years. Next n number of years. And these cash flows are respectively CF1 for year 1, CF2 for year 2, CF3 for year 3, CFN for year n. Now their present values, there is a very simple way to calculate it. The present value, that is the value at time V0, is all these cash flows, CF1, CF2, CF3, till CFN, all these values, each of them discounted to the present time, that is t is equal to 0, right? Discounted to the present time, that is c is equal to 0. So to discount it, if you have read rates and returns, we need a rate of return, right? Let's say that rate of return is R. This R, how do we measure it? This R is basically the cost of capital. The cost of capital, right? Of the company, XYZ, whatever company we are dealing with, we are trying to find out the value of that company, right? So this R is basically the cost of capital of this company XYZ. How we measure it? We will again get to it in a very short while. Just be with me here. So this R we are using for this present value calculation. So CF1 discounted to present value will be CF1 divided by 1 plus R to the power 1. CF2 will be CF2 divided by 1 plus R to the power 2 plus CF3. This will be CF3 divided by 1 plus R to the power 3. This entire expression is nothing but the present value of CF3, that is cash flow 3. This entire expression, second one, this is nothing but the present value of cash flow 2. The first expression is the present value of cash flow 1, right? Similarly, we add all these present values. We add all these present values to get the valuation, which is the sum total of all the present values of the future cash flows, right? Now CFN, what this will be? It's easy, right? CFN divided by 1 plus R to the power n, right? Now we add all this up. What we get is the sum total of the present values, right? Now Modigliani and Miller, they were concerned with how does the capital structure impact this cost of capital and the valuation. So Miller and Modigliani wanted to understand how a capital structure impacts the valuation and the cost of capital. And they went about it and they derived certain very, very interesting propositions, right? We will discuss about that. Now friends, value of a firm, this is equal to the market value of its equity plus the market value of debt. This is how we calculate the value of a firm when we are talking about Miller and Modigliani propositions. Market value of equity and market value of debt. In shorthand, we can write it like this: V is equal to E plus D, right? Then there is cost of capital, cost of equity and cost of debt. So let's say cost of capital is R, cost of equity is RE and cost of debt is RD. Another thing we use, which is called R0. R0 is basically cost of capital when a company has zero debt. When a company has zero debt. And when there is some debt, what we measure is RWAC, weighted average cost of capital. How we measure it, friends? It is the weighted average cost of equity and cost of debt. So this R0 and RWAC, these are basically two cases of cost of capital R, right? So the question remains, how do we measure return on equity and return on debt, right? Return on debt is, simply speaking, the interest you get when you invest in the debt divided by the market value of the debt, right? It can be 5%, 6%, 7%. We already know at the time of purchasing, right? Because we are purchasing at a certain price and the interest rate is declared beforehand. It can be fixed, it can be flexible, whatever, right? And cost of equity, this has multiple ways of measurement. One way is CAPM, Capital Asset Pricing Method. What is that? That is basically measuring the cost of equity with the help of risk-free rate and market returns. How do we do that? Cost of equity is equal to risk-free rate plus beta multiplied by market return minus the risk-free rate. Beta is basically the volatility of the company, let's say XYZ, with respect to the market. Which basically means if the volatility of XYZ is more than the market, then beta will be greater than 1. If the volatility of XYZ is less than the market, then the beta will be less than 1. How we calculate it? It's part of a separate chapter which we'll discuss when we discuss those chapters, equity investments and all. Here we'll focus on Miller and Modigliani propositions, the assumptions and the subsequent propositions in two circumstances. One is with taxes and another is without taxes. Now friends, to make their propositions of valuation and cost of capital in general market scenarios, they started off with the simplest market format. And for that, they had to make certain assumptions, right? Certain assumptions. We will talk about those assumptions first, then we'll get into the propositions. So let's get on with it. Now the propositions that Miller and Modigliani made were made under certain assumptions of market scenarios. What were those assumptions? Let's get to them one by one. Miller and Modigliani assumptions. The first one is homogeneous expectations. What do we mean by that? Let's say there are n number of investors, all of them value companies in similar ways and all of them have similar expectations of the macroeconomic scenarios, right? When they are valuing a company, let's say XYZ, they are valuing it under the same expectations and they also have same expectations of the macroeconomic conditions, right? This is homogeneous expectation. The second is perfect capital markets. Perfect capital markets. What does this mean? This means that there are no transaction costs and there is no information gap between investor to investor. All investors know the same things. Cost of borrowing is equal to risk-free rate. What do we mean by this? Investors can borrow at risk-free rates. Fourth point, no agency costs. Now friends, in investments, generally there lies something called agency risks. What is agency risk? For example, you are looking to buy a stock. Let's say you are looking to buy a certain stock named ABC. Now, you need to depend or you need to trust that the management of ABC will act in your benefit, that is the investor's benefit. The management of ABC will act for the maximization of investor benefits, right? This is a dependency that an investor in ABC has. If you are trying to invest in ABC, you have this dependency. So this is also a risk. If the management does not act in your favor or act in the investor's favor, then in the long term or in the short term, the investor will be in detriment. This is called agency risk or agency cost. Now, Miller and Modigliani assumes that there are no agency costs, which means the management is ethical and works to maximize the investor's wealth. So no agency cost means management is working to maximize the investor wealth. There is no cost involved here. And the fifth assumption, the last assumption, this is the financing and investing decisions do not influence each other. The financing and investing decisions are independent. Let's say you have 100 bucks, but you want to invest 200 bucks, right? You want to invest 200 bucks. Now you can do two things. Either you can take loan of 100 bucks or you can wait for earning another 100 bucks, right? Now usually what can happen is when you take a loan, you are more defensive. If you are spending your own money which has less risk, there are no interest payments, EMI payments, then you can take more risks. But if you take loan, you have a burden of loan, then you can take less risks. What this assumption is saying is that whether you take a loan or whether you don't take a loan, that means your investment decisions do not depend on how you source the investing funds. So whether you take a loan or whether you wait for yourself to earn another 100 bucks, your investing decisions is not influenced by that, right? This is what the fifth and last assumption is. Another important thing is when Miller and Modigliani make their propositions, they make it under two conditions as we have already spoken. One is with taxes and another is without taxes. Without tax, there is no tax. This proposition comes under the perfect market condition only, right? No taxes. In the second set of proposition, this part, no taxes part, is made flexible. So we consider what happens when there are taxes. So there are two cases. One is a set of propositions when there are no taxes, and the same propositions, how they change when there are taxes. This is what we'll look at. The rest of the assumptions remain same. Only taxes and no taxes, these two combinations or permutations we consider. Okay. Now let's get on with it. That is Modigliani and Miller propositions without taxes, right? There are two propositions. One is with respect to the value of the firm and the other is with respect to the cost of capital of the firm. Firstly, regarding the value of the firm, it says that the value of the firm does not change depending on the capital structure if there are no taxes. So, let's say there is a firm A which is having no debt, that is debt is equal to 0. And in another case, this same firm A has a debt of, let's say, 50%, right? Therefore, equity is 50% in this case. In the previous case, equity was 100%. Now, in the first case, let's say the value is VU, that is V unlevered, V without debt. And in the second case, let's say the value is VL, value with leverage, with debt. What Miller and Modigliani say is, value of the firm when there are no taxes is independent of the capital structure. That is, VU should be equal to VL. The valuation of the firm is not different in any case. You make the debt 10%, you make it 20%, you make it 80%, it does not matter. If there are no taxes, the value of the firm does not change. It remains constant. Okay. This is the first proposition. So let me write it down. So proposition 1, when there are no taxes is value of a firm does not depend on capital structure if there are no taxes. So value of an unlevered firm, that is a firm with zero debt, is same as the value of a firm with little debt or lots of debt, right? But what does change? What changes is the risk of the equity holders changes. Let's say if a firm has 80% debt, the equity holders have more risk, so they will ask for more returns, or they will ask for more return on equity, right? This is directly related to the second proposition. The second proposition says cost of equity. Cost of equity is directly proportional to the amount of leverage, or cost of equity changes linearly with increase in amount of leverage. Cost of equity increases linearly with increase in leverage or debt. So let me write it down. Now friends, if we look closely at the first proposition, at the proposition 1, we can find out a few things here friends, if we look closely. First, let's see what is the valuation of a firm. How do we do that? Valuation of a firm is nothing but the present value of its future cash flows, right? Let's say the firm earns cash flows for n number of years, right? So in year 1, let's say it earns CF1, year 2 it earns CF2, year 3 it earns CF3, and like this it earns till CFN. Now the present values of all these individual cash flows, is nothing but the value of the firm at time 0. So this V is actually V0, value at time 0. Whatever future cash flows are there, we reduce it or discount it to the present value and we get this. Now how do we discount it? We discount it with the help of cost of capital. R. Now R has two formats. One is when there is no debt and when there is debt, right? So when there is no debt, the cost of capital is R0. When there is debt, the cost of capital is RWACC, weighted average cost of capital. So let's take the first condition, that is when there is no debt. So CF1 will be discounted by the cost of capital when there is no debt. So 1 plus R0 raised to the power the time period, which is 1 year or 1 period. CF1 divided by 1 plus R0 to the power 1 plus CF2 divided by 1 plus R0 to the power 2, because 2 periods have gone by, plus CF3 divided by 1 plus R0 to the power 3 plus plus the nth year's cash flow divided by the cost of capital when there is no debt raised to the power n, 1 plus the cost of capital when there is no debt to the power n, because n periods have passed by. So this is nothing but the V unlevered, VU. This is case 1 when there is no debt. When there is debt, case 2, when there is debt, how do we calculate friends? V0 or in the proposition we have written it as VL. This is equal to CF1 divided by 1 plus RWACC, weighted average cost of capital, raised to the power 1 plus CF2 divided by 1 plus R to the power RWACC, weighted average cost of capital, raised to the power 2, because 2 time periods have passed by, plus CF3 divided by 1 plus R, weighted average cost of capital, raised to the power 3, right? Plus plus the nth period will be, it's easy to understand, 1 plus RWACC divided to the power n, right? Now, according to proposition 1, the second case V0 and the first case V0 are same. Second case V0 and first case V0 are same. The second case V0 and the first case V0 are same because VU and VL are same, right? These two values are same. The cash flows are same in both cases, CF1, CF2, CF3, CFN, right? So, what is the other variable, friends? The other variable is R0 and RWACC. So for V0 to be constant, in both cases, these two also have to be equal, right? These two also have to be equal. R0 has to be equal to RWACC for the first proposition to hold, right? Now the second proposition says that in absence of taxes, cost of equity increases linearly with the amount of debt. Right? Increases linearly with the amount of debt. So we have to prove this. And we go about it. First we assume that the firm has debt. Therefore, we have to find out what is the R WACC. Let's find it out. So let's say the value of a firm is V. Its market value of equity is E and its market value of debt is D. Therefore, value of the firm is nothing but V is equal to E plus D, right? Now, weight of equity in this firm is equal to E by the value of the firm. Market value of equity divided by total value of the firm. And weight of debt is nothing but market value of debt divided by the total value of firm. Now friends, let's say RE is the cost of equity and RD is the cost of debt. Therefore, the weighted average cost of capital RWAC is nothing but the weighted average of RE and RD. We have seen this previously, which means this is equal to weight of equity multiplied by cost of equity plus weight of debt multiplied by cost of debt. This is equal to E by V multiplied by cost of equity plus D by V multiplied by cost of debt. This is equal to RWACC. But because unlevered firm's value is same as levered firm's value, R0 is equal to RWAC. So we replace RWAC with R0. So R0 is equal to E by V plus into RE plus D by V into RD. This implies we multiply with V on both sides. This gives us R0 into V is equal to E into RE plus D into RD. Equity into cost of equity, debt into cost of debt. Right? These are the market values, remember. E and D are market values of equity and debt respectively. And V is therefore the market value of the firm. Now, V is equal to D plus E. Let's write this down here. R0 into D plus E is equal to E into cost of equity plus debt into cost of debt. Implies R0 into market value of debt plus R0 into market value of equity is equal to market value of equity into cost of equity plus market value of debt into cost of debt. Now let's do one thing. We want to find out how RE is related to debt. So let's do one thing. Let's take this expression on the other side. So Here we can write E into RE is equal to R0 dot D plus R0 dot E minus RD dot D. This expression, we have just reversed the expression and written it here. Now we do one more thing. This D and this D we take common. So R0 dot E plus R0 minus RD into D. This becomes the entire expression. Equity into cost of equity is equal to R0 into equity plus R0 minus RD multiplied by D. This becomes the entire expression. Now friends, if we divide both sides by equity, what happens? If we divide both sides by equity, that is E, this happens. RE is equal to R0 plus R0 minus RD multiplied by, now friends, R0 is constant, RD is constant. Therefore, as the D increases, D by E, this ratio goes up, right? If this ratio goes up, then RE also has to go up, right? If this ratio goes up, RE also has to go up. And this relationship is linear. You can see there is no to the power exponential or square or cube or anything like that. This relationship between RE and debt equity ratio is linear. So we have hence proved Miller and Modigliani's proposition number 2, that in absence of debt, the amount of debt that is D increases the cost of equity. Let us write this equation separately. RE is equal to R0 plus R0 minus RD into D by E. Now friends, each and every firm faces two kinds of risk. One is risk due to its own unique business nature, which is called the idiosyncratic or the non-systematic risk, and the risk due to the overall markets, that the overall markets may go bad. That kind of risk is also there, right? This is called the systematic risk. So the risk which is unique to its own business is called non-systematic risk, and the risk which is because of the entire market going through cycles, that is called systematic risk. And each business has both of them to larger or smaller degrees, right? Now, because of non-systematic risk, the more the leverage, the higher is the probability of default or even bankruptcy, right? The more the leverage, the higher is the risk of default or bankruptcy. And because of systematic risk, the higher the leverage, the more is the cost of equity. The higher the leverage, the more is the cost of equity. How? It can be derived from an equation called the Hamada equation. Let's see how that looks like. Let's say the beta of the assets of a firm, that is the volatility of the market value of the assets of a firm, is beta A, and the volatility of the market value of its debt is beta D. These two are related to the beta of its equity, friends. So these two, beta A and beta D, are related to the beta of equity, that is the volatility of equity market value also. How? Basically, beta of assets is the weighted average of beta of equity and beta of debt. So let's say the firm has a total value of V, its debt market value is D, and its equity market value is E. So beta A is given by value of equity divided by total value multiplied by beta of E plus value of debt divided by V multiplied by beta of debt. If you rearrange this equation, this equation becomes very similar to the previous equation of cost of equity. Let's see. This equation, when rearranged, like previously I have done here, it becomes beta equity is equal to beta asset plus beta of asset minus beta of debt multiplied by debt divided by equity, right? This equation, this previous equation is called the Hamada equation. This equation does not take default into its consideration, but it takes the volatility of the market value of equity, asset and debt, right? And this looks uncannily similar like this previous equation that we had, right? So from this equation we can see if the debt to equity ratio increases, then volatility of equity does increase, that is the beta of equity does increase. Now friends, these are the two propositions of Miller and Modigliani under the condition where there are no taxes, without taxes. We have already gone through the assumptions. From there, only one thing we are going to change now. From without taxes, we are going to make it with taxes. So let's see what happens there. So Modigliani Miller propositions with taxes. Proposition 1 is regarding the value, right? Value of a firm increases with the amount of debt linearly, and that is the increase is equal to debt multiplied by the tax rate. The increase is equal to debt multiplied by the tax rate. This is the amount of increase. Let's say the value of a firm when it is unlevered is VU. Now it takes up a debt of D and its tax rate is T. Therefore, the value of the levered firm becomes equal to V unlevered plus D into T. This is the value of a levered firm. And this is proposition 1 of Miller and Modigliani when there are taxes. So let me write it down. Value of a firm increases with leverage by an amount equal to the debt tax shield. Debt tax shield is equal to nothing but the value of the debt multiplied by the tax rate. This is called the debt tax shield. Okay friends, how this calculation happens you will get to understand when you specifically go into the income statements. Okay, let me do one thing. Let me demonstrate it here. Let's say a company has taken a certain debt and its present value is D. Now it is, let's say, a n number of years debt, right? So 1, 2, 3 till n number of years the debt is there, and each year there will be a certain amount of payment, right? Let's say in year 1 there is a payment of D1, small d1. Year 2 there is a payment of small d2. Year 3 d3. Like this, year n the amount paid is dn, right? It can be the same amounts or it can be coupon, then ultimately coupon plus the principal. It can be any which ways. It can be equal EMI like this. Doesn't matter, right? There are payments after all. Now what happens to the income statement? Let's say the profit in each of these periods before payment of interest and taxes, that is PBIT, profits before interest and taxes in each of this period are P1, P2, P3, ... up till Pn. This is profit before interest and taxes, friends. Now, after interest payment, that is profit before taxes, we have paid the interest, only taxes are left. After paying the interest, what are the profits? This is equal to P1 minus D1 because we have paid the interest or the EMIs, whatever that is, financial costs we have paid. P1 minus D1, P2 minus D2, P3 minus D3, Pn minus Dn, like this, right? Now what are the tax implications of these profits, friends? What is the tax paid in each of these periods? Let's see. In period 1, taxes paid is P1 minus D1 into the tax rate T. Tax rate is T. In period 2, it is P2 minus D2 into T. In period 3, it is P3 minus D3 into 3 into T, right? Dot dot dot. Nth period, it is Pn minus Dn into T. So this is the total amount of tax. Now consider a second scenario where there are no debt. There is no debt, right? In this case, this D1 is not there, D2 is not there, D3 is not there, Dn is not there. These all payments, interest payments are not there, right? So the profit remains at P1 for period 1, P2 for period 2, P3 for period 3 till Pn at period n. These are the profits which remain. There are no interest payments, right? So the entire taxability will be on this entire profit, right? So taxes paid in the second case when there are no leverage or no debt. Let's say the tax rate is T. This becomes P1 into T, P2 into T, P3 into T, dot 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 Pn into T. Now friends, consider one thing. Let's say period 1, P1, and let's compare the tax amount paid. In case when there is interest payment, the tax amount paid is P1 minus D1 into T. But when there are no taxes, the amount paid is P1 into T, right? P1 into T. Obviously, you can see this amount P1 minus D1 into T will be less than P1 into T. By how much? By D1 into T amount, right? D1 into T amount. In period 2, this amount will be less by D2 into T amount. In third period, the amount will be less by D3 into T amount, right? Right. So if you sum up all these amounts that is saved, it comes to be summation of all the Di into T. The present value of all this, let's call it dt. This is the tax shield, right? The present value of debt multiplied by the tax rate. And here your equation is understood better. VL is equal to VU plus the tax shield, dt. We have broken up the dt to understand it better. Now we move into proposition 2. In case there was no taxes, what was said, friends? Cost of equity is a linear function of the amount of leverage, right? When there are no taxes. And when there are taxes, what is the difference, friends? So the previous equation was cost of equity RE is equal to R0 plus R0 minus RD into D ratio. Here there is one minor adjustment due to the tax rate, which is you multiply R0 into RD into 1 minus T into D by E or DE ratio. This is the only adjustment. So here we write the cost of equity is still a function, a linear function of the leverage with an adjustment for the taxes or the tax rate. Let me write it down. The cost of equity still increases linearly with leverage, but this time there is an adjustment for taxes. And this adjustment is downward, friends, because we are multiplying by a factor which is less than 1, right? 1 minus T. So initially if the value was R0 minus RD into D by E, this time this entire expression is multiplied with something which is less than 1. Let's say 0.75 if the tax rate is 25%. Or let's say 0.8 if the tax rate is 20%, like this, right? So there is a downward adjustment. So the cost of equity increases this time also, but increases a little less. So these are basically the propositions of Miller and Modigliani, and we have taken both taxability and no taxability into consideration, and we have understood what is the tax shield, how it functions, how it impacts the value of the firm, how leverage and taxes influence the cost of equity, right? We have understood all of that. Now friends, we understand what is optimal capital structure and what is target capital structure. What do we mean by it? Optimal capital structure is that capital structure at which the value of the firm is maximized. So let's say you have multiple options of capital structures. Let's say you have multiple options of capital structures. One is you have 20% debt and 80% equity. Second is you have 30% debt, 70% equity. Third is you have 20% debt, 10% preferred shares and 70% equity. Now, after doing the valuation in the projected cash flows and cost of capital, etc., you find that the third option maximizes your value. So this becomes your optimal capital structure. Now, what is target capital structure? Target capital structure is basically a kind of capital structure or debt equity ratio which the management is trying to arrive at. Let's say the management wants a target debt to equity ratio of 0.5. This means if the value of the firm is, let's say, 100 million, then value of debt would be how much, friends? Debt will be 0.5 into equity, because DE ratio is 0.5. This is the target debt, right? So value is equal to debt plus equity, which is equal to 0.5 times equity plus equity. So this is equal to 1.5 times equity. Therefore, if the value of the firm is 100 million, equity here will be 100 divided by 1.5. This is equal to 66.67 approximately, which means debt will be equal to 33.33 million, right? 66.67 million equity and 33.33 million debt. This is how we calculate the target debts and equities, right? Now, in the medium to long term, the target capital structure should tend to merge with the optimal capital structure, right? Now, friends, according to Miller and Modigliani proposition, if taxes are there, then leverage actually benefits the value of the firm, right? Leverage actually benefits the value of the firm. But through common sense, we can understand that increasing leverage increases the probability of default, the probability of bankruptcy, the volatility of equity, etc., right? So leverage can be useful up to a certain extent, but after a certain amount of leverage, it can become very harmful. So we have to incorporate this in the value of the firm, right? So as we go on increasing the leverage, the probability and the cost of financial distress also increases, right? The cost of financial distress also increases. Let us incorporate this factor into the value of the firm. So, value of a levered firm is equal to value of the unlevered firm plus advantage due to the tax shield. D is the value of debt, T is the tax rate, minus present value of the cost of financial distress. This present value tends to increase with increase in leverage. And what happens if, let's say, the financial distress cost is taken out? The financial distress cost is 0. What happens then? Then also after a certain point, friends, the advantage starts to peak and mean revert. So advantage reverses after a certain point. Let us see through a graph plot. Let's say the vertical axis represents the value of the firm, value of the leveraged firm. And the horizontal axis represents the leverage, the amount of leverage. Now, the initial value, let's say, is here. This is the value of an unlevered firm. Leverage is 0 at this point, right? Here, the higher point is the value of the unlevered firm. Now, as we increase the leverage on the right hand side, the value starts to increase. It increases, but up to a certain point. From there on, the slope becomes flatter and flatter, and ultimately mean reverts. This is even without the present value of financial cost. This is even without financial distress cost incorporated to this, right? Now, if you incorporate the cost of distress also, then what happens? If you incorporate financial distress into it, then the curve worsens further. And this worsening aggravates as you increase the leverage. Right? As you increase the leverage, the curve becomes worse and worse. Right? So this is how financial distress and the cost of it impacts the value of the firm. Just going on leveraging the firm does not actually increase the value. Even if you take out the cost of distress, it does not pay after a certain point of time. If you incorporate the cost of distress, it worsens the probabilities, it worsens the prospects further, right? Now, as we have said before, in the mid to long term, the target capital structure should tend to merge with the optimal capital structure. But in the short term, it may deviate, right? It may deviate. Now, how does an analyst or an outsider understand what is the current target capital structure? There are basically three simple ways of doing it. One is the easiest way, which is assume. Assume that the current capital structure is the target capital structure. Be alert about management stake and the patterns of the capital structure to understand what is the target capital structure. So management statements and capital structure patterns and trends. You make use of these informations to understand what can be the probable capital structure. The third is you compare it with competition or comparable companies. Comparable companies or businesses. Right? These are the three ways in which you can understand what is the target capital structure of a business. Considerations that affect capital structures. Number one, while designing capital structures, what the management considers is the policies and target capital structure. Policies behind designing the capital structure and the target capital structure. The second factor that can be considered is financing investment opportunities. Financing investments. Do you issue debt? Do you issue equity? Like that. Number three, market conditions. Let's say when the management projects that the future is looking a little bit distressed, they may stay away from issuing debt, right? Or let's say if they project that the stock markets may grow further, they may resort to public offering of stocks, right? The fourth one is information asymmetry. So generally, the management wants to issue capital in a way that minimum amount of information gets leaked in the market, right? Minimum amount of information gets leaked in the market. So these are the four factors. Let us do one thing. Let us discuss each of them in a little bit more detail. There can be various policies which a company may adopt. One can be avoid unnecessarily stringent conditions over debt issuance. For example, avoid excessively strict debt covenants, because excessively strict debt covenants may actually hinder their growth. Next is avoid falling of debt ratings. If the capex targets are too high, or if too much borrowing is happening, sometimes this happens that the rating agencies become defensive. And they may reduce the ratings, keep it under watch, or keep it under watch with negative implications like that. They may change the ratings. Let's say the management wants to avoid it. Third is comparison of market value versus book value. Let's say At t is equal to 0, the company issued debt at 5%. And at t is equal to 1, the interest rates went up to 7%. Alright? Interest rates went up to 7%. Naturally, the book value of their debt will be more than the market value of their debt, right? The book value of debt will be more than the market value of their debt in this kind of a scenario. This scenario will make them avoid issuing new debt. This scenario will make them avoid issuing new debt. A second case, let's say when they issued the stock, when they issued their IPO, a business issued IPO, the stock index was at 1000 points. Now it is at 2000 points. And their market value has gone up, let's say 3x. Their market value has also gone up 3x. In this kind of a scenario, it can be advantageous for the company to go for a further public offering. This is called follow-on public offering, right? So, market value to book value comparison. Next, we come to financing investments. Now, let's say a company is looking to expand, right? A company is looking for expansion. And it's a startup. It does not have much access towards debt. It does not have much access to debt. So, the only option that it has is issuing equity. And it will be done through venture capital or private equity, right? Now, if the expansion is for a conglomerate, like let's say Unilever. In India, it is called Hindustan Unilever. And it has had a historic strategy of growing through acquisitions. HUL, when trying to make acquisitions, they can easily access debt. They can easily access debt because they have healthy return on capital, they have healthy free cash flows, which means they have great ratings. Right? Great ratings because they have a huge reputation, a long reputation with high performance, etc. etc. Or let's say a mining company. A mining company is looking to go greenfield, right? A new expansion altogether. Because they have good number of assets which can be collateralized, right? Assets can be collateralized, they can go for debt. Now we come to market conditions. As we took the example before, let's say a company issued a debt at t is equal to 0 at 5%. And 2 years or 1 year down the line, let's say t is equal to 2, the rates have changed and they have become 8%, let's say. In this case, the market value of the debt that this company issued will be less than the book value of the debt. And as a result, if they want to issue new debt, it's going to be detrimental for them. And if you see simply also, they had issued debt at 5%, right? Now, the interest rate is 8%. Why should they look at issuing debt anyways? And it can be also looked at this way. The market value and the book value comparisons also result in them deciding against taking debt. Now, if the reverse happens, let's say at t is equal to 0, they raise debt at 8%. But 2 years later, the rates became 5%. In this case, it is very wise to sell off the old debt and issue new debt, right? To sell off the old debt and issue the new debt. The new debt they will get at a lower rate, and the old debt they can sell at a higher price, higher market value. On the other hand, let's look at the equity markets. Let's say the management is projecting that stock prices are going to grow. They are growing and are going to grow in the future also. This may motivate the management to issue equities. Right, friends? Now we come to the fourth point, which is information asymmetry. The management, theoretically speaking, is mostly looking for minimal information leakage. Whenever they are trying to raise capital, they want that to happen at a minimum information leakage. Now, if they are going for FPO or IPO, that requires a lot of information to be released. And it is available publicly. Even retail investors have access to that, right? Second is, if they look at issuing debt, then generally a little bigger HNI investors get mostly involved in it, right? HNI investors. Retailers can get involved in it, but through mutual funds mostly. They generally do not access bonds that much as they access equities, right? So, in this case also there is lots of information leakage. Maybe not as much as equity, but still lots of it, right? The third option is internal funding. If they do internal funding, the information leakage is minimal. So, there is a theory called the pecking order theory. This pecking order theory says that the first option for the management is internal funding because minimum information leakage. The second option is debt. There is information leakage, but maybe not as much as equity. And obviously the third option is, and the last option is equity, public equity, which entails maximum information release. So this is the pecking order theory. The first option, internal funding. Second option, debt funding. Third option, equity funding. Ideally speaking, the management's duty is to maximize shareholders' wealth. But this ideal does not always happen. There can be misalignment of interests. And this can lead to the management not acting towards shareholder wealth maximization. Management digressing from the path of maximizing shareholder wealth. This is called agency cost, and specifically agency cost of equity. Now, a company has shareholders and a company also has stakeholders. We will try to understand what are their interactions and what are the implications of those interactions and probable conflicts in the next section. So friends, who is a shareholder and who is a stakeholder? Let's understand. When a company is interacting and doing business, there are certain kinds of participants who come along with the company, right? Firstly, there are the provider of debt. So there is public debt, there is private debt providers, and there is the bank which is also lending. So public debt providers are there, private debt providers are there, and bank lenders are there. This is one set. Another set is the shareholders. Let's say the minority shareholders and the controlling shareholders. These are the shareholders, right? Are there any other shareholders, guys? Yes, there is a preferred shareholder also, which is possible. Preferred shareholder, right? So these are equity providers, and on the left hand side we have the debt providers, right? So collectively they can be called providers of capital. Now apart from these, who else interacts with the company? Who else transacts with the company? There are other participants also. They can be employees, suppliers, customers, dealers, it can be the society and the environment, and regulators and government. Now, there are two ways of looking at all these participants. One is the shareholder theory. Shareholder theory says that the corporate governance of a company, the corporate governance of a company, its primary duty is to look at how all these factors, all these providers of capital and other participants impact the shareholder wealth. This is the shareholder theory. And the other theory, which is more recent, is called the stakeholder theory. Stakeholder theory says that corporate governance should not only look at maximizing shareholder wealth, it should also look at how the company impacts every participant and every stakeholder with the company. So this includes employees, suppliers, dealers, customers, environment, society, regulators, government, everything, right? All stakeholders, how they are impacted, how they are benefited, that also has to be taken into account. This is the new stakeholder theory, and in some places this is part of the company's law, right? Now, who are the stakeholders? All these participants, the debt providers, the equity providers, the employees, the suppliers, the dealers, the society, environment, regulators, government, everybody. This entire set forms the stakeholders. Okay? Now, as they interact, obviously, if the management takes a decision which favors one of the parties, it may so happen that the other parties get impacted. Now, how these conflicts arise, we will look at them one by one in a very brief way. A management which is aligned with the interests of the shareholders tries to maximize shareholder wealth. They try to maximize shareholder wealth if they're aligned with the shareholders, if their interests are aligned with the shareholders. But that might come at a cost, friends, because return on equity, which is a measure of how efficiently the equity is being used, increases if debt is increased, right? Return on equity increases if you increase debt, but increase of debt is something that debt providers do not want. Debt providers are against increasing leverage. So, if you try to increase shareholder wealth and in the process you take leverage and increase the return on equity, that goes against the debt providers. So, therein lies a conflict. So, the best way is to find a trade-off. Between the two. And there are other factors also, like debt terms and conditions, covenants, which restrict the management from taking excess leverage, or they restrict the management from issuing dividends, or they can restrict the management from issuing further equity. All these things can happen. Also, one more example can be a management may find that the market conditions are suitable to a public offering. Now, the public offering will dilute the stake of each shareholder. It will dilute the stake of each shareholder, and in the process, the shareholders may not like this. The shareholders may be against this. But the debt holders do not mind. This, because they find that capital is coming to the company while financial distress is being avoided, right? While financial distress due to excess debt is being avoided. So they may like it. They may not be against it. So these are certain conflicts that can arise in this kind of a scenario. The next one is controlling shareholder and minority shareholder conflict. A retail investor may be looking for growth rather than dividends, right? Because the corpus invested is very less and the dividend returns will be very minute. They are looking for growth. While the controlling shareholders might be looking for dividends at the same time. they may be routing for a large dividend at the same time. This can create a conflict of interest. Then there can be information asymmetry also. Between the minority and the majority shareholders, there can be information asymmetry. This can also create conflict of interest. Public offerings may harm the minority shareholders by diluting their stake. On the contrary, if the controlling shareholder wants to grow the business and takes single responsibility and decisions for the good of the business, that can work in favor of the minority shareholders also. This can also happen. Employee versus shareholder conflict. So let's say to maximize shareholder wealth, debt is being taken up. Lots of debt is being taken up. Now, this will increase the fixed costs or fixed expenses, fixed financial expenses. This in turn may damage the work environment, stress up the work environment, and if financial distress happens, then there can be job loss also, right? So this can go against the employees. This can go against the employees, very much so. Similarly, this can also happen to the suppliers. If the company goes bust or defaults, the suppliers can be impacted also because the payables may be pending. Payables may be pending. The dealers may get impacted. They may have a standing infrastructure which may have to remain idle for some time because the company is not able to perform well, right? Similar things can happen. There can be other obvious conflicts like a mining company and environment, or a chemical company and environment, a fertilizer company and environment, right? A fuel producing company and environment. All these conflicts are very obvious and keep happening, and we are trying to change the laws, we are trying to change the way we do things also, right? How we do farming, how we do transportation, all these things we are trying to change. We are trying to shift to other modes of transportation. We are trying to create other alternatives to existing chemicals that we use. All these things are happening. So these are conflicts that have to be dealt with in a very careful way. Look at what are the stakes and how we can shift it towards a more balanced stakeholder relationship where all the stakeholders get the maximum amount of benefit, right? A trade-off scenario basically. So friends, that's about it for this chapter. If you have doubts regarding any sections of this chapter, you can share in the comments, or if you want one-on-one consultation regarding doubt clearances and maybe also want to take curriculum related support, mock test, etc., the enrollment links are given in the comment section and in the description below. Please check them out.
Do you have doubts which you want to get clarified one-on-one? Doubt clearing sessions, mock tests, full curriculum related support and counseling sessions. We have a bunch of enrollment options at Finavision. Do check out the link in the description and in the comment section below. Thank you so much friends for being with me in this video. If this video added value to you, do consider liking and subscribe to the channel. If you think that this video can be of help for someone else, do share it with them and do share your own feedback in the comment section. Till then, keep watching the videos on Finavision YouTube channel. Thank you so much once again.